Well, what we decided today was to inject an additional £75 billion of money directly into the economy. And we did that because the world economy has slowed substantially in the past 2 or 3 months. America has slowed, China has slowed, and of course particularly Europe has slowed. And that's affecting our ability to export, it's affecting the state of our banks, and it threatens our recovery. So that's why we took action today.
And is this more a kind of Euro crisis concern or more a UK crisis concern? I mean, specifically, are you worried about the fact that the UK may now be more at risk of recession?
Clearly, the impact of the rest of the world on the UK does threaten our recovery. That's why we took action today to try to head that off. The problems, however, are originating in the rest of the world, partly in Europe, but also partly in the imbalances in the world economy between the East, China and other countries in Asia, and the West, the United States. These problems have been with us for 15 years, and they have not really been tackled. And until we tackle them collectively in the world economy, we won't get to the underlying roots. But we've done what we can in the United Kingdom.
But specifically, I mean, the UK, the last time this was done, back in 2009, the UK was in the depths of the worst recession since the 1930s. Surely there's now a concern that that is, again, a threat that is facing Britain.
I don't know what is going to happen to the world economy, and we are not immune to developments in the world economy. But what we can do is to take measures at home to try to head off the threat of shocks from overseas, and that's what we've done. We've taken preemptive action to try to prevent the slowdown from becoming too serious. Now, I don't know what's going to happen in the rest of the world over the next few months or years, and we'll have to respond and react to what happens. What I do know is that a rebalancing of the world economy is as necessary as a rebalancing of our own economy.
And what would you say to Eurozone policymakers in particular? They seem to be in the spotlight at the moment. They're facing what people would regard as a crisis in the euro area. I mean, what kind of advice would you give to them?
Well, we discussed with them in private things that could be done. But what I want to do is to try to explain why it is that these problems have become so intractable. In essence, what has happened is that over many years, some countries have had big trade surpluses and others big trade deficits. The countries with trade deficits have been spending more than they've been earning, so they've had to borrow from abroad. And they've been doing this year after year. Countries like that are the United States, ourselves, and some other countries in Europe. That cannot go on. And there are two ways in which this can come to an end. Either, and we're seeing this in some other countries in Europe, if they can't find new ways to become competitive, then their ability to repay the debts is called into question. Another way of doing it, which we followed, is that we've got a credible plan to repay our debts, and the value of sterling has fallen by 25% to make our exports more competitive and attractive to overseas buyers, and it to be more attractive for British consumers to buy from British producers rather than overseas producers. That is what we have done to put in place a framework to rebalance our economy. And I'm sure that's the right way to do it.
But you mentioned sterling. I mean, one of the effects of quantitative easing, according to most research, is that it does tend to bring sterling down. There are concerns now that the world is facing a new kind of strain of currency wars. And some people might say that the Bank of England doing this more quantitative easing is going to increase the likelihood of those currency wars. In fact, just make it actually happen.
I don't think that's right. And indeed, it was precisely the attempt to stop exchange rates moving that has been the source of many other problems. If we hadn't had a fixed exchange rate between China and the United States and Asia and the United States dollar, if we hadn't had fixed exchange rates within monetary union, perhaps the scale of the imbalances would not have built up to the level that they reached. Movements in exchange rates are a safety valve which allow these imbalances to unwind gradually and steadily. It's the natural way that a market economy responds. If you prevent the market economy from responding in that way, then you know you're going to find difficulties. And that's why within the euro area, they're having to find now alternatives to currency movements in order to find ways to improve the competitiveness of those countries in the south that have lost a lot of competitiveness. And that's not going to be easy to do, but that's the challenge that they face.
What would you say to those people who say that this is effectively the Bank of England printing money? They have concerns about this driving up inflation, whether it's inflation in their pockets or whether it's inflation of assets around the world. I think a lot of people are really concerned that this policy is building up inflation but not actually necessarily helping them?
Well, I understand why they're concerned, but let me explain why I don't think they should be. For most of our lifetimes, there has been too much money in the United Kingdom economy. Too much money has been printed and injected into the economy, and that did push up inflation. So inflation has been the major challenge for most of the post-war period. That's why we ended up with an independent Bank of England to stop it happening. Since the world financial crisis, we're now facing the opposite problem. There isn't enough money in our economy. This is very unusual, but it's happening. It happened in the 1930s, and it's happening now. The amount of money in our economy altogether actually fell over the past year. In underlying terms, it may be growing at about 2% a year. It needs to grow faster than that. That's why we are creating money in our announcement today, to inject more money into the economy, to ensure that the economy can keep growing. Now, I know that people are worried about inflation, and I know that inflation, in 2 weeks' time, we'll get another inflation number, which may well go above 5%. But that, in our view, is the peak. And it will then start falling, and in the first few months of next year will fall quite rapidly, so that the underlying inflationary pressures will disappear during the course of next year. And one of the reasons we took this measure today is that our concern is that the balance of risks now is that inflation may be difficult to imagine today, but next year it could well fall at the end of the year or in 2013 below the target. And that's why we've taken this measure, to keep inflation close to the target once the effect of this measure seeps through to various parts of the economy.
But how can people be sure that we're not... These are the kind of policies which in some ways have been tried out in countries like Zimbabwe and the Weimar Republic in Germany. How can we be sure that that's not the same path that we're heading towards in the UK?
Very simply, because what happened in the Weimar Republic and in Zimbabwe was that the amount of money that was created grew at thousands and hundreds of thousands of % a year. It's not growing by thousands of a % a year, it's actually fallen. And if we can get back to our underlying growth rate of somewhere around 5 or 6%, we should be able to maintain steady growth with low inflation. So I think what matters is not that people think that we're creating money. We are, but we're doing it because there's not enough money in the economy. Now, that may seem unfamiliar to people, but it is unfamiliar. That's because this is the most serious financial crisis we've seen, at least since the 1930s, if not ever. And we are having to deal with very unusual circumstances, but react calmly to this and to do the right thing. And the right thing at present was to create some more money to inject into the economy.
You say people aren't familiar with it. It's been done before. We've had £200 billion worth of quantitative easing. And some people are concerned that that hasn't necessarily worked. I mean, you know, there are people, for instance, Andrew Sentence, from the former Monetary Policy Committee member, who says that he doesn't think that more quantitative easing would necessarily do the trick. I mean, how do we know it's actually working?
Well, no one can ever be sure, and I respect Andrew's judgment. But people can take different views on this. The view of the committee is very clearly and solidly that at present, and you can see from the numbers, the amount of money in the economy is growing too slowly to enable us to sustain a recovery. And the world has changed. I mean, many people thought, even 3 months ago, that the issue facing the committee was when to raise interest rates. But the world has changed, and so was the right policy response. That's why today we are expanding the amount of money. And I think that is why monetary policy is the right way to take the strain of changes in the world economy.
Some people might look at what the Chancellor, George Osborne, said earlier this week and talking about he was encouraging activist monetary policy, and then see that the Bank of England took this decision only a few days later and argue or imply that there's been some kind of pressure applied to the bank.
Well, I can assure you that there hasn't. Neither any member of this government nor of the previous government ever put pressure on the Bank of England to take a monetary policy decision other than the one we wanted to take. There are 9 members of our committee, each is an individual, each has an individual vote. Their votes will be published in 10 days' time. You'll better see how each person voted. And I think it'd be pretty amazing if anyone really believed that this was taken as a result of pressure.
Can you rule out ever carrying out more quantitative easing after the 75 billion?
No, because we can never rule anything out. And I think the great attraction of using monetary policy in these circumstances is that, unlike fiscal policy, The government can't change its spending programmes or its plans for the health service up 2 months and then down again 3 months later. We can in monetary policy. As I said, 3 months ago, there was a debate as to whether interest rates should go up. Now the debate is about how much asset purchases should take place, and indeed that's a widely expected position in the financial market. So when the world changes, we change our policy response, and monetary policy has the ability to change extremely quickly. That's its big difference from fiscal policy.
Just one final question. Couldn't you have come up with a better name than quantitative easing? It sounds like a medical ailment, to be honest with you.
I have never used the phrase that you just expressed, and I won't. It's asset purchases. But I prefer it very simply to be, are we injecting more money into the economy, or are we taking money out? And that's, of course, exactly what we do when we change interest rates. This is very similar to a change in interest rates. We tighten monetary policy, we ease monetary policy. When we tighten monetary policy, we take money out of the economy. When we ease monetary policy, we put more money in. These things can be reversed when it's appropriate, according to the state of the economy. That's why monetary policy is the right policy to deal with present circumstances.